Welcome to Chit Chat Stocks. This is our Thursday Power Hour episode where we talk all things financial markets over an hour. I am one of your hosts, Ryan Henderson, and I am joined as always by Brett Schaefer. And we can talk all things financial markets, anything that's in the news, any topics we want to discuss. I'm going to be talking my small cap of the week, which is a bit of a unique one this week. And then I've also got the 10 best performing share cannibals of the last decade, which we can kind of dig into the results of that. And we got a couple other topics as well. Brett brought some stuff to the table. But before we get into all that, we want to talk about our friends at Public. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it's the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on Public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. That's no commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. Public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. Let's get into things. Brett, you want to kick us off here? Do you have any topics that you want to discuss?
Well, the big one, Ryan. Nvidia, top dog, number one
That is
market cap in the
insane.
world. What are your thoughts?
I get it, I guess. Like, I get the enthusiasm, but it is absolutely insane that that could happen in such a short time frame. And Beth Kindig was right.
She was. She did say Apple, but I believe that was the largest market cap at the time, so it's sort of come to fruition. And I think, and I don't want to put words in her mouth, but I did see that she doubled down and said $10 trillion. So putting the chips back into the table. But go confirm that, whatever the actual number is. I did see she made a new prediction, so we'll see.
Yeah, I think if you're going to own it from here, you basically have to believe that it's going to be $10 trillion eventually, right?
Well, yeah, I guess over the next 10, 15 years, sure. But if you're holding it and it's been a 100x for you, I don't necessarily think you need to believe that. You probably just need to believe it's going to keep up its profits in a stable manner and then return a bunch of cash back to you as a shareholder, right? Even if it's a 100 bagger and you get a 1% dividend yield over at some point over the next few years, well, you know, you got all your cash back already.
Yeah, I saw this insane stat that I want to find and double check it. So let me make sure. Let me see if I can pull this up. Okay, yeah. Chris Bloomstrand said Nvidia passes Microsoft and Apple as the largest market cap combined. The three are valued at $9.9 trillion, 21.5% of the entire market cap of the S&P 500. So those three alone, 21.5% of the S&P. The Mag 7 is now at 34%. And
Of the S&P?
yeah, they now comprise 34% of the S&P. And those seven alone have $16 trillion in combined market value. That's more than the S&P 500 as a whole in February 2016.
Wow. That's a lot. Now, I did have, maybe we just roll right into this topic because this was one of mine for the week. And it was around this Chris Bloomstrand thread. Anyone on Twitter can go find it. It really, I guess, put some stats out there, as you mentioned, Ryan, about how big these companies are. And I want to go through a couple of them and see what you think. And what we've been talking about, a few of them too. He talked about Costco, which is something I believe he follows. I don't think he owns, but here's what one thing that stood out to me. And it's a thread, so it's not like a essay type sentence. It's Nvidia is valued at 42 times trailing sales and 78 times trailing earnings on an unsustainable 54% net profit margin. Now, how likely do you think that statement, unsustainable net profit margin, is true? Do you think that's, I mean, people like to say base rates, reversion to the mean, stuff like that. And sometimes I think that gets overrated. But in this case, I think you are making a huge bet against a reversion back to the normalized earnings power if you think this margin is sustainable. What do you think?
Can you repeat the question one more time?
Okay, so he says there's valued at 42 times trailing sales, obviously high, but the earnings ratio isn't even that much higher because it's at a 54% operating or net profit margin, 78 times trailing earnings. How likely do you think it is that the trailing profit margin is sustainable? Because it's a big bet against a reversion to the mean.
I don't know. I would typically say, yeah, it's going to
Probably.
come back down, but it also, I would be lying if I pretended to have any sort of grasp on Nvidia's advantage and whether or not it's something that can last or whether something like competitors could actually catch up to it. Why do you think it would come back down?
Well, again, this is not a part of the market that I'm an expert on at all, but I would say that the thesis is probably that there's going to be an increase in competition. Even if they're still the leader, there will be an increase in competition as there is such a huge incentive to basically take those profits and make them ourselves with Google's TPUs, Amazon, Microsoft doing that. Now that might take a long time and maybe they don't catch up, but that would be the thesis that I would have um, if I was going to make that bet. But I think the key maybe to look at it as an investor is I would say it's probably, we can't deal in absolutes. It's probably unsustainable just because it's just unlikely that a company can maintain that profit margin. I think a good rule of thumb that I look at is if the profit margin is super high, that also means the moat needs to be very high because you need to protect that huge spread versus your cost versus the profit that you earn. If you earn a 5% profit margin, well, maybe the moat you have is actually the low profit margin, similar to a Costco or a Walmart or an Amazon in e-commerce. But if you have a 55% profit margin like a Visa or a MasterCard or Nvidia, you got to have a really, really wide moat because otherwise someone can step in there and undercut you. And I think with Nvidia, there's a lot of uncertainty there. But obviously, as you mentioned, they've done so well so far. It's not something that we know that well. And hey, that competitive advantage could be as wide as some of those top profit earners like the card networks.
Yeah, I think that's probably what investors today would claim, right? That's probably why they own it, is the margins are deserved and can be sustainable because they're so far ahead of everyone else. And it's kind of this chasing game of innovation. And if you're the leader, it seems like you continue to be the leader in semis for at least with the NVIDIA's GPUs. It sounds like no one's really catching them.
Here's a question for you from the comments. First one, James Goodwin. We have the two, always joins. Thank you for joining. Says looking forward to the crash, which, hey, could happen. I think we'll get to another part of his thread here that I think is maybe a bit provocative, but he could definitely be right. And then Tyler says, do you guys think TSMC, that is Taiwan Semiconductor, the manufacturer of NVIDIA's chips, will begin to demand higher prices from NVIDIA? Would that damage margins? I mean, yes, it would damage margins. And I think that's one thing that would concern me as well versus some of these other really high profit margin businesses is that they do have suppliers that may have just as wide of a moat as them. So is ASML, all the semiconductor equipment companies, going to sit back and let NVIDIA take all this margin? Or is TSMC and Samsung and Intel going to, or I guess, they don't use Intel as a foundry, but Samsung and TSMC going to let them sit back and take all this margin? I'm not sure. And maybe that NVIDIA does have all the power here to say, hey, look, we'll go somewhere else if you want to raise prices by 50% on us, if they were talking to TSMC. But from what I've read, well, TSMC is the only game in town for super low nanometers, but TBD.
Here's the thing that blows my mind. If you would have told me, let's say 4 years ago, I'm just pulling up the numbers now just to make sure I'm not crazy. Okay, if you would have told me 5 years ago, NVIDIA is going to be the largest company in the world by market cap, I would have thought for sure that this was trading north of 100 times earnings.
True.
Like you would not have thought that it was purely, well, not that there hasn't been some valuation or multiple expansion as well, but the fundamental improvement here, or the improvement in revenue and earnings, is I'd almost argue it's more crazy than the change in the stock price alone.
Yeah. Yeah, that's true. I mean, yeah, obviously there has been fundamentals there.
It was a $100 billion, it was a $93 billion market cap in June of 2019.
Yeah, it's been quite a run. Now, this is another part of the Bloomstrand thread. It's actually the end, but I think it relates perfectly to what you're saying here. Mr. Market is very good at rewarding success, but to a fault. In the short term, stocks can trade at extremes relative to fundamentals, but on the low side and on the high side. At 23 times 24 expected earnings, the market cap weighted S&P 500 is froth with excess and, in my judgment, uninvestable. Now, he also has another part here where he says, this is the goofiest and likely most dangerous concentration of overvaluation I've seen in 34 years investing and throughout financial history. That includes the dot-com bubble. What are your thoughts on there? Is this worse than the dot-com bubble? If it's not, it's getting closer by the day.
No, it's not worse than the dot-com bubble. Look,
Right,
it's
maybe.
showing.
Hey, look.
Okay. Hey,
you go first. You go first.
It's showing up in their financials. The dot-com was fluff. Like, these were pre-revenue businesses. I would say the SPAC craze was crazier than this. Like 2020, 2021, that bubble was crazier than this. The difference here to me is that it's just people extrapolating out the existing growth rate maybe further than they should. But previously, there was like no revenue growth rate. As Tyler says in the comments here, it was .com had 100 times price to click ratio, like not a price to revenue or price to earnings, whatever. At least there's some actual fundamental improvement here.
Yeah, that to a point, yes. There was the pets.coms. There was plenty of other ones like that. Those were small companies, though, and there were the big four at the time, which I'm hopefully going to get all four. I know three at the top of my head: Microsoft, Oracle, Cisco, and Intel. And these are real businesses. They were trading at extreme valuations. And what happened with someone like a Cisco or some of these telecom equipment companies or the internet equipment companies, which I don't know if it's going to mirror it exactly, but what would worry me is that during the dot-com bubble, there was such a big spend on this and people overspent for almost 10 years. And then once they realized that there was such a supply glut, a cyclical business like semiconductors went through a huge drawdown, or these computer equipment companies, and revenues fell 90% for a lot of these businesses. So I think that could happen because, I mean, it's a similar thing. It's not guaranteed to happen, and there has to be, the expectations are obviously higher now that the AI spending will generate actual, profits for these companies. But I could see that scenario happening. And it wasn't all, from what I remember reading, it's not all zero revenue companies at the time, although it may have been a combination of the SPAC era and today, into one.
Yeah. No, look, maybe Nvidia itself. The thing that concerns me about Nvidia is the revenue that it's earned over the last 12 months. That is not guaranteed revenue. Like, that's not a locked in revenue base for the next 10 years. It's not like
subscription.
Yeah. These aren't super long contracts. As far as I understand, it's not guaranteed recurring revenue. So you do have to believe that spending on AI and GPUs will continue to rise, and you have to believe that Nvidia will be the primary distributor of those chips and maintain their lead. So, like, I don't know, if you believe that, I guess you can find a way to rationalize the valuation here, but I think that would be pretty extreme. I like Bloomstrand because he does really good work, but he sometimes comes off as like a little too bearish for me. Sometimes, like, we did this. We're like, this is an AI bubble a year ago.
Yeah. We still could be right, but obviously it could continue the opposite direction. Like a few years from now, we could be proven terribly wrong or completely right, but either way, no one will remember. So, okay, the other part, we don't need to talk about this stuff forever because we don't want to just be CNBC that talks about Nvidia's stock split all day, which is some nonsense. But there was another part in this that related to a poll that I did on Costco. He says essentially stuff we've been saying here. Costco has a 2.8% profit margin, 54 times earnings, going to grow sales pretty slowly. Blah 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 blah. My question is, you're at a essentially 2% dividend, or excuse me, earnings yield. And I guess this wasn't as controversial as I thought it would be because it's kind of related to when I think almost a year ago, exactly a year ago, when you did a tweet about Visa not stopping their buyback and just sitting on treasuries because that's a higher yield. I said, should Costco basically sell as much stock as it can and buy treasuries because you're selling your stock at a 2% earnings yield and then buying treasuries, short-term treasuries at 5.5%. What do you think about that, Ryan? Is that getting too cute? Because I kind of look at, hey, some of the great capital allocators of our time, Buffett with General, whatever that one, that reinsure. You have Henry Singleton at Teledyne. I think they would have done something similar, but what do you think?
Yeah, and to kind of go back to that, people kind of dunked on me for that tweet. Like, should Visa stop the buyback and put more money towards treasuries? But it seems to be what they've done to some degree. They didn't stop the buyback, but their percentage of excess capital that was distributed to buybacks versus treasuries skewed more towards treasuries as yields kind of went up and the multiple on Visa grew as well. So grew in sync with it. So their free cash flow yield relative to treasuries didn't look quite as good. Now you don't want to stop it in total because you'll probably lose a shareholder base. And I think there's some value to just being consistent in that regard. But yes,
True.
it's hard to do. It's a hard pill to swallow, but I would probably issue shares if I were Costco.
Yeah, I think if you were saying I have a fiduciary responsibility to my shareholders, you would try to do that. I would guess. And
What do you think's more overvalued, Costco or Nvidia?
ask me in 3 years, we'll know for sure. Nvidia has such an uncertain outcome. Costco, I think, is almost guaranteed to be overvalued unless it feels the craziest to me. But when you look at it, I gotta think like, okay, is it one of those times where everyone is just going into housing bubble mode where they're like, it goes up forever because it's a good business, or am I just missing something? I'm not sure. But it seems the one where it's just there's not that much upside. Where Nvidia, you go, hey, AI is going to take over the world. It's the new internet. Sure, it'll do fine. Sort of how like Microsoft and Oracle are above their 2000 highs. Hey, maybe that could happen, but they're two entirely different businesses. We have some comments here. Do you guys think this time the froth is in the businesses that are still private? How many AI companies are getting multiple billion-dollar investments right now? Yeah, it's a good point. We have no idea, but it seems like there's a lot of kind of nonsense going on in these private AI companies, but we don't really know for sure. Let's see. Once all these private businesses go bust, Nvidia's earnings could fall. Yeah, that's true. That is true. There needs, they are. You need the whole supply chain to be working here. Let's see. We have something on your Visa take. Treasuries don't grow revenues at 8% or 12% in Visa's case. Yeah, but I think you can compound them. You can reinvest.
Yeah, right. I mean, the revenue growth isn't really what matters here. It's like if you have the chance to buy your own shares in your own business at a 2% free cash flow yield versus buying treasuries at a 5% free cash flow yield, your business, you're right, treasuries don't grow revenues. Well, they don't have revenues, so they don't grow revenues. But in the next year, it is potentially a better use of your capital. And it's a better use of capital for your shareholders.
And you can reinvest.
Yeah, and it's not like
people act like it doesn't
you
compound.
You can buy back shares later.
Yeah, exactly.
It's not the end of the world.
Exactly. And I think when something's maybe at 35 times earnings and they're buying back stock and the treasury yield would be like a 20 times earnings if you flipped it around, you can make that debate. But when it's as extreme as Costco, and I don't think they're buying back stock. I think they understand capital allocation fairly well. But it's almost like flipping around the idea of I have a super depressed stock, but I have consistent earnings and I can take out some low, cheap debt and buy back stock. It's almost the opposite of that, where I think some of the great, the outsider level capital allocators would be taking advantage of this. And they should. And Buffett has in the past.
Yeah, I would. I kind of feel for Costco shareholders at this point. Like, if you're buying shares today, I just don't see the upside. I don't get. What do you think about their special dividends? They frequently distribute out special dividends. At this multiple, does that really make sense? I mean, I
I think it
guess you
doesn't
can do
matter.
that.
I don't think it doesn't matter. Or sorry,
Yeah.
I don't think it matters at this multiple. Like dividend doesn't matter.
Yeah,
You
I
know.
was asking, I asked on Twitter basically, would isn't it better to just buy treasuries? And everyone's basically like, yeah, probably not. It's better to just give it to investors and let them choose to buy treasuries if they want. And so I think that's
Yeah, that's
probably the
fair.
right way to go.
Yeah, but if you're gonna have cash on the balance sheet, I don't think you should be buying back stock. You should maybe try to sell it at the 2% yield to see what happens. But I know Costco doesn't operate like that, and they're not gonna be turned into a conglomerate overnight just because the stock's expensive. But other companies maybe. Okay, new topic. Ryan, do you have one of yours? You want to hit the activist stake? My favorite activist stake I saw, in a long time.
Yeah, I saw you were quite excited about this. So I guess a little bit of context here. Starboard Value has amassed a $500 million stake in Autodesk. Um, Autodesk has been treading water for quite a while. There has been some we've been shareholders and we've expressed some concerns about capital allocation and frankly management in general, maybe just having the wrong uh, objectives, measuring themselves using the wrong measuring stick, aka optimizing for rule of 40 when you really aren't that you're not at the stage of a software company where that matters anymore. So anyway, we thought there'd be an activist at some point. An activist has come along, and here's a couple quotes from CNBC. So activist Starboard Value has a $500 million stake in Autodesk and is weighing legal action over the company's delayed disclosure of an internal investigation into accounting malfeasance. This is kind of where it gets interesting. It says Autodesk moved its chief financial officer to a new role after an internal probe found that executives reversed a shift in billing structure to inflate the company's free cash flow and operating margins. Those two metrics determine executive pay and measure company success. Starboard is concerned that Autodesk delayed disclosing an internal probe until shortly after the nominating deadline for the company's board, which would potentially limit a shareholder's ability to nominate its own candidates in a contested fight. Maybe it's just the way these bullet points are laid out, but that sounds, I don't know, a little damning. And
Yeah,
it's
so I read or go ahead.
I was going to say it is a little funny that they said, "Oh, nothing came of the investigation, but we've removed our CFO."
Yeah, well, they changed it to a new role. They invented it called Chief Strategy Officer, which does she have blackmail on these executives? Because I don't, that's a joke, but like why would she still be there? I don't really understand. You're going to be paying her a lot of money as a chief whatever officer.
Also, uh if they use this investigation to add another executive, that's a bummer. Also, um, I don't really know if the CFO should be the one that moves to chief strategy. Like
Yeah.
maybe an engineer or someone involved with the product.
Yeah, well
Depends, I
also the
guess, what
CEO.
strategy means.
Yeah, the CEO is also the chief strategy officer if I understand that role um, correctly. But I think the key here is so they did that thing where they basically secured their board of directors while they knew this thing was going on, but didn't announce. They delayed releasing that the investigation was going before an activist like this could step in. So they're going to go legal action to see if they can renominate people. But I think the most damning part is that they found evidence that the company switched from upfront payments from big customers to more extended payments on an annual basis. And if you go from upfront to annual, it's going to change your free cash flow number. Now, they were telling investors that they were still doing this, changing from upfront billing to annual subscriptions. But in practice, they were actually they reversed it to doing upfront billings while not telling investors, because they were going to miss their free cash flow numbers. And that means the business wasn't doing as well as they thought at the time. And guess what the executives are paid on, Ryan?
Sorry, I was on mute. Free cash flow.
Yeah. So it was a bit misleading in all regards. Obviously, it doesn't look good on this management team. And we had a question in here about how much the stock would pop if the management team left. I don't know. It's always hard to tell in that regard. I almost wish that it would go down, because you want that situation where a company that's can grow revenue super, super easily, which I think has a wide moat, gets a new management team in there that can maybe fix some problems. But it doesn't sound like that's going to happen. It's interesting because the stock doesn't even look that cheap, but maybe it's because those margins haven't gotten to the level that they think they can get them to. Curious, does it make it more bullish or bearish on Autodesk, Ryan?
No, it solidifies my belief that this management team is bad. I know that Andrew Anagnos was maybe not the one necessarily pulling the strings. It sounds like maybe it was the CFO, but it happened under his watch. It's kind of that they are who we thought they were meme, where we kind of thought these are mercenary executives that have come in, they get paid exorbitant amounts, and it's a business that isn't that hard to run, and they seem to be optimizing it for themselves and enriching themselves in the process. And it was I don't know. I mean, this investigation seems to prove exactly that. So yeah, I think this is one of the more, this is a ham sandwich company where it doesn't require that great of a CEO or executives. It's a wonderful product. It's ingrained, embedded in the workflows of architects and engineers around the world. And I would love to see these executives replaced, most of them.
Yeah, that'd be good. Hopefully, it's a big battle and the stock goes down because of uncertainty. I would love that, because I still don't think it's that cheap. Although, if you can believe in margin expansion, yeah, it would be pretty cheap. I did like how you used our good friends at FinChat, which will be our next segment here, on basically showing the growth in revenue versus the growth in stock-based compensation, which is quite astounding. I think stock-based compensation has grown 700% in the last 10 years, something like that.
Let me pull it up real quick.
And I always make sure when doing these if I'm going to comment on something on Twitter, to at the CEO, just so when he opens Twitter, I don't know how often he opens it, but if he opens it once a month, he sees some ads from me saying, "We're watching you. We know you're doing this malfeasance."
Yeah, I thought that was quite a hilarious. I think it's funny that you tagged him. Wow, look at this chart, Andrew Anagnost.
Yeah, exactly.
I
don't think he minds. He's probably got a nice house in the Bay Area where they're located.
Okay, so
All right.
I am pulling it up right now. Hold on, just give me like 2 seconds.
Let's see. We got some comments here. Someone said Autodesk rejected my application for their senior revenue accountant position. Executives compensated ex SBC. Guess how much dilution via SBC is going to occur? True. And someone says, hello from Europe. I see Power Hour now live. I tapped the link. Hello. Thank you, Quant Compounder, and appreciate it. We got a global audience over here. This is kind of funny seeing the data from the what is it, whatever our podcast aggregator is, and it's quite the international audience. It's cool to see sometimes. Only about half from our home market in the United States, and a lot from Europe, Australia, Asia, even all the different continents. It's awesome. All right, Ryan, what do you got? Got to load it up?
It seems to be having a hard time populating what I'm looking for right now, but I think I can do it. Yeah. I
Essentially, it
got
was
it. Sorry.
700% SPC and 150% for revenue, something like that. I can probably do it
Yeah.
too.
No, okay, I got it. Sorry.
Okay.
Sharing my screen now. Sorry, it's just because it's a little wonky because you got to do like the percentage change and stuff. But I am opening it now. Okay, so I know this doesn't make for great audio, so I apologize if you're listening to the podcast. But basically, I just since 2006, because there was a big stock-based compensation that occurred in like 2004. I think that was related to the IPO. So it's
The
not
IPO was a long
encapsulated
time ago,
here.
but no.
Oh, yeah, that's right. I don't know what it would be then because it makes it look very extreme. But basically, revenues have tripled since 2006, which is actually lower than I would have expected. It's up 207% roughly. Stock-based compensation over the last 18 years is up around 628%. So it has trounced the revenue growth. So very concerning for the business, very concerning for shareholders, I guess you could say.
Yeah,
I
for
think it's a little bit of
everyone
a letdown.
watching, orange is SPC, blue is revenue. Yeah, for anyone watching there.
Yeah, it's kind of bugging out on my end. So anyway, yeah, bummer. At least there's an activist on board now. It's good to see that. They are who we thought they were. I guess that's kind of the moral of the story here.
Yeah, I think that sums it up. We'll keep following this story. I think it's quite an interesting one from one of the businesses I think is one of the best in the world. But let's hit another topic, Ryan. We're about halfway through, so I think that means time for your listicle, which is this week about share cannibals. So why don't you go to that segment?
Sure. So I was looking at some share cannibals, which the way I'm just defining that is companies that have bought back a lot of their stock over a sustained period of time. You can kind of quantify it however you want. I did companies that bought back more than 5% of their stock annually over the last decade, which it's hard to do that if you're a company that grows quickly because you're probably going to get a premium valuation. So it's difficult. You basically have to be valued quite cheaply in order to buy back more than 5% of your stock every year. But only 46 companies in the United States have bought back more than 5% of their stock each year over the last decade. Interestingly, most of these have underperformed the market.
Wow.
I guess that kind of makes sense because a lot of these companies are kind of at the stage where there may be low to no growth and they don't know what to do with the cash flow that they have. So they just buy back stock.
And there's been a lot of multiple expansion driving the broader market.
That as well. But there are some gems in here as well that have been misvalued, I would argue. And they've been able to both grow and buy back stock over the last 10 years. And so I'm going to go through 10 of them. These are the best performing ones. So the number one best performing share cannibal is Murphy USA, the gas station operator. Primarily operate throughout the Southeast, Southwest, and Midwest, I believe, because they don't have any up here in the Pacific Northwest. But yeah, they have compounded their total return performance. They're up 25% a year over the last 10 years. I can pull up the more specific numbers actually to get down to it. But yeah, they were the best performing stock by quite a lot. The second highest performer is Louisiana Pacific. I'll say this is a company I had never heard of prior to seeing them in the screener. They sell building products for new home construction, repairs, remodels, stuff like that. They have reduced share count by 48% over the last decade, and their total return is 578%. So pretty solid. I'm not going to go through all the numbers. I think I'll speed this up a little bit. But third best performer is Pulte Group. It's a home builder. Fourth, O'Reilly Automotive. Fifth, Lowe's. This is an interesting one because so the sixth one here is AutoZone. So O'Reilly and AutoZone have both been valued very similarly. And they've both been able to buy back a lot of stock. They've had the same tailwinds to some extent. They've had the same tailwinds where cars on the road continue to grow. The average age of cars on the road continues to rise as well. So it's just overall increases in serviceable customers. But Lowe's, who you would think is benefiting from a lot of the same tailwinds as Home Depot, has they have not grown the business quite as quickly largely because Home Depot has done so well optimizing their existing stores and uh, also catering to pros. But they've been able to generate similar, if not better, returns purely because they're valued at a discount to what Home Depot is valued at. So their buyback has been really incredible. So yeah, they've been the fifth best performer here. AutoZone 6, 7, Ameriprise Financial. 8 is Dillard's. This is an interesting one because it's one where I would not own the business if it were trading at like 15 times earnings. It's
Yeah, you
retail
hear that, you
department
go,
stores.
unownable. That's what I think. But it's done well,
Yeah,
right? Because they essentially went up like 600% because they just bought back so much. It was so
yeah.
cheap.
It was, and I'm not sure what exactly happened here, but so in 2019, they were doing about $6 per share in earnings. And over the last 10 years, they've bought back 66% of their stock, which is one of the fastest pace buybacks I've seen, other than maybe AutoNation might have done more. So $6 in earnings per share in 2019. 2022, $42 in earnings per share. I guarantee you that is not because this is a rapidly growing business. Uh, they sell fashion apparel, accessories. It's big retail department stores. It's not a glamorous business, not hyper growth, but it's a good example of a management team with a good head on their shoulders being rational about the way they allocate capital, and they've done a good job. And they've actually been able to just operate okay. I would have thought they'd been crushed, but they've done all right.
Yeah, they're
Number
pricing in.
nine.
Oh, yeah, sorry. Yeah, the rest of the list.
Yeah, let me just finish up here. Number 9, Group 1 Automotive. They own automotive dealerships, franchises, and collision centers throughout the US and the UK. Actually, a pretty intriguing business, honestly. Earnings per share have grown at 24% annually. Trades at an EV to EBIT of 8 times. So
Wow.
kind of intriguing there. Similar, it's kind of in a similar boat to AutoNation, where you operate these dealerships and there's some ebb and flow with the auto market generally. So maybe it's kind of potentially a cyclical here. Then the last one is Credit Acceptance Corp. They just provide financing programs to auto dealers in the US. I guess I'll let you kind of give your thoughts here, and then I'll give, I don't know, some of my takeaways looking at this list.
Yeah, so I while you were talking, I pulled up Murphy USA here on FinChat. I'll share the screen here in a minute, but I will say if you want to use any of these cool screeners, you can actually do it for international stuff as well. All these different sectors. It's a really, really robust screener now. You can go over to finchat.io/chitchat, get 15% off any paid plan. We love using them. It's a wonderful product and they improve all the time. We just added median, or not we, Ryan works there, but they just added median, min, and max on the charting, which can be quite interesting, I think, to help visualize whether a stock's trading at a premium valuation. I mean, for example, we talked Nvidia today. You could check that out in the past, valuing cyclicals, all that stuff. I mean, you could even do a screener with stuff over at, Japan, Korea, even something even smaller like Thailand. I mean, they're building it out even better every day. So finchat.io/chitchat. But let me share the screen here. I have shares outstanding at Murphy USA along with earnings per share growth. Let me pull it up to get the exact numbers here, but I'll read them out. So we got shares outstanding declining at a very consistent rate, 8.2% per year since December 2014. But what's interesting is that earnings per share really didn't go anywhere from 2014 to 2019. They actually went down slightly. And then during the pandemic, they've boomed and now stabilized over the last couple of years. What would you think seeing this chart, Ryan? Would that scare you or not? Because it feels like maybe the pandemic helped them a ton, or maybe I would just have to investigate what was going on in kind of 2017, 2019 range because maybe they're reinvesting or something, and they all that bared fruit over the last few years, but something that I wouldn't be concerned about, but I would need to know why, earnings per share growth has been so sporadic.
If I remember correctly, I, I believe Murphy is one of the gas stations that actually earns a decent spread on the gas prices, as opposed to uh, a lot of convenience stores. They'll sell the gas essentially at cost, and then they'll make money on the goods in store, selling food and stuff like that. I believe Murphy earns a good spread on the gas, so the fuel revenue. And I think gas prices shot up during that time period, if I'm not mistaken. So that might have had an impact as well. I would have thought though they'd keep their spread similar, so I don't know how much it would impact earnings per share, but might have had
Yeah, it's
some
a good
impact.
point. Yeah. So I still think it's an interesting chart though, and seeing an 8% per year decline is quite good. I usually like to see, like I get excited when I see 3% per year over an extended time period, but if you do 8% decline for 10 year, I mean, that can be quite good. Let's see. Tyler asks, what companies do you think will be on this list in 10 years? What do you think, Ryan?
My bet is there will be a good amount of home builders on this list. There's a amount of home builders already on the list, but if we zoom 10 years out and you think that the supply and demand balance for home builders in the US is okay, a lot of them trade really cheaply right now. So I would suspect they're going to be able to buy back. Where I think you get leaders in share cannibals, where companies that really reduce stock by a lot, is when there's like a common narrative that doesn't hold true. So like AutoZone and O'Reilly, electric vehicles are going to eat up a lot of the market share for O'Reilly and AutoZone, or a lot of the potential customers. They're not going to be able to sell as much products. That just really hasn't held true. The number of internal combustion engine vehicles on the road has continued to grow, and it's just basically been this tailwind for them, where that narrative has let the stock be cheap, but they've continued to generate cash and be smart about how they allocate it. So cars on the road, that kind of is one that's maybe a false narrative. Potentially, if you believe that home builders aren't going to be able to sell as many homes, or they're going to, there's going to be this big downturn in the real estate market in general. If that's the narrative out there, which it seems to be the narrative, that real estate's going to struggle because of the multiples that we're seeing on a lot of home builders, if that's false, I imagine they're going to be pretty high on this list in 10 years.
Yeah, I agree. That makes sense. Someone here said Ulta Beauty. They buy back stock and the stock's gotten cheaper. So, hey, if it keeps being perennially cheap, it could stay there. We have a comment that says boring, out of favor, and good at capital allocation. That's what he's saying with all these companies. I think that's true. When looking at that list, one of my takeaways is you have to be in an industry that's not sexy. And as you mentioned, the other tenant there as well that I agree with, where you have stuff that no one is really getting excited about. It's not going to be in the homepage of the Motley Fool with the top trending article writing about these companies. So I I guess you'd have to look at something that people are too bored about. Someone mentioned tobacco, but they pay too much in dividends. But that can make sense if they were buying back all that stock there, right? Because the narrative is that the profits are going to go away, and if they don't, if they bought back a lot of stock, that would help. I think another one people talk about the energy sector. I don't know how that's a little cyclical for me, but I don't know. Maybe there's some stuff with stable earnings. Who knows? Don't know about it that much. But yeah, what do you think?
The other thing that seems to be a trend here, at least when you look at like Murphy, O'Reilly, AutoZone, Polta Group, Lowe's, these are businesses where their size has afforded them the ability to take share, because they can sell goods at a lower cost, or reinvest some of those margins back into being a better provider for customers. Like O'Reilly, for example, they've stolen a lot of share from kind of your mom and pop auto parts stores. Lowe's, certainly, if you've got like home improvement type of retail location, I bet it's real hard to compete when Lowe's and Home Depot come into your market because they get such low rates from suppliers. It's just companies that have also gained share. Even though it's a slow growing industry, all of those, the share growth has allowed them to also kind of grow revenue at a quicker pace.
Right. And I think what's dangerous and counterintuitive is if something starts randomly growing 20% revenue growth. For example, we talked about Elf Beauty or Hims and Hers, which we actually have a question on Hims and Hers. I don't think we could answer because I don't know the answer to it. But, if something starts accelerating revenue a ton, that multiple is going to expand. But if you keep revenue growing at 5% for 10 years and the earnings multiple is below 10 and you buy back stock, hey, that's a great recipe for 15%, 20% compounded returns. Someone mentioned Cole here as well on the chat. We got a lot of people saying they enjoy the interactivity with the chat, so we'll keep doing that. I think if more people start joining, it'll be harder. I don't want to get to that point where it just starts scrolling and you can't even read anything, but I guess that's a good problem to have. But let's move on to the next topic. And Ryan, do you want to talk about our friends at Public again and then go to your small cap of the week?
Yeah, and I think you're gonna like the small cap of the week as well, Brett.
Restaurants. Hey, I like restaurants.
You do like restaurants. Anyway, so before we get to that though, earlier in the show, you heard us talk about the investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. Let me pull up pull up my small cap of the week. So we've gotten a little bit of love on Twitter actually for this new bit that we're doing, segment, if you want to call it that. Small cap of the week. I've got a thread now of like 20 in my notes app on my folder. So I'm just going through these, finding the ones that are like the best. And the other thing that I have found while looking at some of these micro caps and small caps, there is not, other than if you're a part of like microcap club, there's really not a single place where you can just constantly find interesting small caps because it's hard to screen for. A lot of these companies are like on the cusp of profitability. Maybe there's a good year, a bad year. It just doesn't screen well. And the companies that do screen well, usually there's something wrong with them. Or, it's a difficult industry or segment of the market to screen for. However, I found this kind of cool book called the Weird Shit Investing ebook. And I think it's a blog, the Weird Shit Investing. I think it's a blog, but the ebook is just 50 pitches, or maybe it's not 50, a little less, but a bunch of investment pitches in a row on small and micro caps. And so one of the ones I came across was Rave Restaurant Group. The ticker is RAVE. It's traded on the NASDAQ. And so Rave is the franchisor of 125 Pizza Inn locations in the southeastern US. Pizza Inn it's like a all-you-can-eat pizza buffet concept. Now, Brett, I don't know if this is getting you excited because I don't know if you're the biggest pizza guy in the world, but I know you like restaurants or studying restaurants, so I'll keep going here. Here's a quote from the ebook. It says, the company has been around since 1958, has a lot of brand value in its local markets, but is largely seen as a dying business that peaked with 700 locations in the 1980s. A new CEO, Brandon Solano, came in October 2019. He helped Domino's turn around in 2008 to 2014 and will do the same with Rave. Solano has stated that he thinks he can 10x store count just by re-entering the old markets that were lost over the last 30 years. So it sounds like this is a pretty poorly run business. Comp sales have looked pretty good over the last 2 or 3 years. Double-digit comp sales at a lot of the Pizza Inn locations, so really solid. And the thing I like about Solano, as well as the new CFO that just came on board, is that they speak like they don't speak too insanely optimistic. They're very clear about what they want to do, and they sound very shareholder friendly. So here's a quote from the new CFO. He says, I am very excited and feel fortunate to join the incredible Rave team at this time when we are focused on right-sizing expenses to grow the bottom line. To generate over $1 million in operating cash this quarter, that was the most recent quarter, was truly impressive. Equally exciting is the company's commitment to revitalizing and growing sales through re-imaging existing restaurants and opening new franchised restaurants. The middle of the P&L is solid and the top line has tremendous growth potential. So they've done a good job controlling costs. They've had 16 quarters in a row of profitability. And now they're kind of gotten to the point where it's like, okay, we're comfortable with our base restaurants here. They're consistently profitable. Now let's work on kind of expanding. It's a $27 million market cap. So this is really kind of a micro cap. $6.3 million in cash, no debt. So basically $20 million enterprise value. They did just over $2 million in earnings over the last 12 months. So a little under 10 times earnings. Thoughts here, Brett?
Yeah, it does seem interesting for sure. My first questions would be to ask, are the earnings normalized, do you think? Like, how much room is there for a margin inflection? Because I wonder if they're at a subscale where the overhead costs are eating up a lot of the potential earnings if they are, 2-3 times as big.
Yeah, I don't have the answers. I haven't dug deep enough on it. I think I struggle with turnarounds of this size sometimes, like, investing in companies.
Too.
Yeah. And they've just had such irregular profitability. Like, if you look prior to the last 16 quarters, the last 4 years, profits have kind of gone up and down. You really have to believe in this Brandon Solano guy because he is the one that took over. 16 consecutive quarters of profitability that's been done under his watch. He does have some experience in Domino's. He was like head of innovation or something like that. So it's not like he was just some like low Domino's employee that happened to be there during the turnaround. He was like, I think, a part of the actual turnaround that they performed. If you believe in this guy, yeah, I think this is probably a pretty good opportunity. And I do like the idea that they've been there in the markets before, so people know them. Like, it's not like they're starting from scratch and have to build a brand.
Yeah, and it sounded like they were around since the 1958. So maybe like over the last decade or two, they lost a little bit of their quality, and they can say like, hey, we're under new management. We got a better system going. We redid our restaurants, all that stuff, type of stuff, like with the re-imaging. And people be like, okay, it's the Pizza Inn of the old. And anyone from the southeastern US, tell us if these things are a good or a bad brand. I'm assuming it's not like a Chick-fil-A level brand, but that definitely seems interesting to me. The balance sheet is, the box gets checked there with some of these companies. You worry about just a distressed balance sheet. So $6 million in cash, which is high for them with no debt. That's good. That gives them a lot of wiggle room, especially to invest. And they're generating operating cash, as you mentioned, for what? Or profitability for 16 straight quarters, something like that.
Yeah, net profitability for 16 straight quarters. And we do have some comments here. Rave is terrible. Terrible locations. That's too bad. I mean, yeah, I'd probably want to talk to some people, I think, in the markets. It does serve like it's mostly working class Americans, meant to be like a cheap way to get a lot of pizza. So I could see a lot of people that have maybe a more advanced palate not liking that.
Well, I think you have to ask with something like this. Yeah, look, if that's been true and they're still earning money and things don't change, well, it might be cheap enough, right? And I think the CEO, from what I understand from looking at this, he understands that it's not the best brand and they're trying to improve it, which of course is tough to do. And it takes many, many years to do that. But hey, if it's priced like it's not going to, that's all upset.
Yeah. And hey,
And
Domino's
I wouldn't
brand
short
was,
it. Go ahead.
the Domino's brand was horrendous in a way. Remember?
Oh yeah, that's a good point. That is a good point.
They had a
Now it's way better,
fantastic
but it took them.
turnaround.
Yeah, it took them about a decade to do it. But yeah, we have someone here saying that I was, I was looking to short this. You can't short a stock like this on that balance sheet. I don't think. I mean, you'd have to look for more distress, but who knows? I don't know how to short.
The other thing that I'm finding a lot of in microcap land is like companies that don't report every quarter, companies that constantly have delays, like stuff where it's just like hard to actually get information. The one thing I did like about Rave is that they seem to be completely up to date with their reporting and have that all
Nice.
figured out. So there was plenty of information available.
What? Yeah. I think it's interesting, and with micro caps, if you're going to have that be a part of your portfolio, I think the key is you need to have higher expected returns, or however you want to describe it, where you need cheaper starting valuations, because like Ryan mentioned, it's hard to follow these companies. There's not that good of information on it. A lot of them aren't the best businesses. They're disadvantaged versus a larger player. So you need that advantage in that, right? We had someone here mention Genk, Genk, as a restaurant play. I think we will look at that as another time. I will add that maybe to your list that we can do in sometime in the
Gank, huh?
the near. Yeah, it's a Korean barbecue buffet growth story. Paul Serro over at Cedar. What's the name of his thing? Cedar Value, I think.
Cedar Grove.
Cedar Grove. Cedar Grove. Yeah, he had some stuff on his Substack on that, which I thought was quite interesting. Now, let's move on to another topic. We got some questions on Twitter. Someone said, have to get Ryan's updated thoughts on Wise. Do you want to do that this week, or do you have
Sure.
anything for maybe next week? Or you
Sure.
read the stuff?
Yeah, I've read most of it. I didn't get through the entire annual. It's like I think it's an annual report. It's like half shareholder letter, half annual report. Which it's funny, like the European reporting methods, it's like an annual report, but you just everywhere there's like management commentary on everything. It just
Yeah, and
feels
then
kind of
200 pages.
strange.
200 pages of ESG.
Yeah, so I guess summary. The second half of 2024 looked good. They uh, continued to grow. We already knew some of the numbers because they have like a temporary report that gives like the headline numbers, but they grew customers. The customer funds held in Wise accounts continue to grow as well. So they were earning good interest on that, which has really helped boost the bottom line. The issue and what drove the stock down more than 10% following the report is that they guided for a little bit of margin compression as well as a decline in revenue growth. So they're expecting lower revenue growth, and management essentially said, we're going to reinvest some of the cash that we have gotten this year, and we're going to reinvest a good chunk of the income that we get to trying to lower costs, transfer cost for customers. So, and the way they do that is investing in the payments infrastructure, which I think it's not easy to build out. There's a lot of regulatory hurdles when dealing with. If you read the shareholder letter, you can see the number of regulatory hurdles that a country like Japan had in getting like bank accounts set up natively in those countries so that you can create true low cost transfers. And there's a whole bunch of restrictions that the governments try to more or less kneecap Wise with. So they say they're going to reinvest a lot of the proceeds into lower transfer costs. If that is really the case, if you believe that they're going to be able to lower costs with these investment proceeds, I love it. I like that story. I like the way that works out. It's scale economy shared. It's the Nick Sleep principle of instead of choosing to return the capital to shareholders right now, they are returning the capital more or less to customers in the form of lower costs, lower prices, which hopefully means greater and greater volume. More and more, I am seeing people raise awareness for Wise or become aware of Wise as the lowest cost provider. And I've seen there were certain corridors where prices rose a little bit, but in general, they seem to have the same goal that they had at the onset, which is to have whatever money without borders, try to make it as low cost as possible. I've explored my alternatives, and for me, I get paid through Wise. It's still the lowest cost solution for cross-border transfers.
Gotcha. Yeah, Makes sense to me. Do you think the stock is down because they said they're going to reinvest and maybe lower their margin a little bit, and the short term analysts and whoever cares about that in the short term is worried about an earnings crunch or whatever it would be, an earnings, you kind of get what I'm saying there?
Yeah, I think that's part of it. The only other thing that is maybe cause for concern is that they said they're going to reinvest into building out their infrastructure for lower transfer prices. And at the same time, the revenue growth guidance was lighter than expected. So I feel like you would think if you're investing in the infrastructure, volume's going to grow faster. So maybe there's something missing there. But I guess if they're passing through some of the prices to customers, then that's going to ultimately hurt their revenue or their take on each transfer.
Yeah, and I think what helps me with Wise is, look, is the moat as wide as someone like Visa or MasterCard? No, but at the end of the day, if we're customers, we're not going to leave if they keep lowering prices and they're equal or better to any competition out there for any specific quarters. Now, maybe Remitly's better at Mexico United States corridor because that's their bread and butter, or maybe someone else is better at some other corridor. But on the whole, they're trying to do as best as possible, and I like that culture of, as you mentioned, Ryan, giving back uh, some of the profits, or as they say, sharing. The economics of the business to try to maintain. I thought what was interesting of reading as a little teaser, we're doing a Nick Sleep Nomad Partners episode next week for our legendary investors study. And I didn't know that Costco actually had a strict, like, we can only sell something 14% above what we buy it for. I did not know they had a strict number there. So I like that same similar concept here where they're saying we're going to earn a specific spread. I don't know if they have an exact number, but it's similar in a way where whatever we earn, we're going to keep that. But that means we want to grow the volume, and then we'll earn the money that way. But we're not going to try to eke out more from our customers, especially when at the end of the day, this is something that is not a huge branded, differentiator.
Yeah. Yeah, I agree. In reading through a lot of those Nick Sleep letters, this was one of the companies that I kept kind of drawing comparisons to just in the way that management talks about like rewarding customers. But maybe that's because I'm a shareholder and I'm biased and it's just recency bias too.
Yeah, confirmation bias on coupon as well.
Yeah,
Definitely.
definitely.
Definitely. It was exciting. Really. But yeah, look out for that next week. We're also going to do one on Molson Coors. I think that's a potentially cheap beer stock. Not so sure yet. And I should remind everyone as we close
Do-
out this episode that when we talk about stocks, we will tell you if it's something we own. And most of the time, 98% of the time, we talk about something, we don't own it. And if we talk about it like bullish or bearish, it doesn't mean we have any hard takes on it. It's just a conversation, because I've seen some comments about it, like when we talk about another company, good luck with this one. I just want to make sure that if we write about something or talk about it, does not mean we own it. We will definitely disclose all that stuff.
Yeah, and I've done three of these small caps of the week so far, and I don't own a single one of them. Just to be clear.
Exactly. Yeah. Trying to turn over some rocks. All right. Thank you, everyone, for joining us. Let's hit the housekeeping stuff. I haven't said this in a while, but if you're new to the show, if you like it, you've discovered us from somewhere else, give us a 5-star review on Apple Podcast or Spotify. It's the best way to grow the show. You can follow us on Apple, Spotify, or YouTube at Chit Chat Stocks. Never miss an episode in that way. And then let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. One more thing. We went live at 1:30 p.m. Eastern Time today, 10:30 a.m. on the Pacific Coast in the United States. I think we're going to change to this from now on just because of Ryan's building has maintenance that goes right by his building at the prior time slot. So we want to make sure the audio is best as possible. So we think we're changing to 1 hour further, but we'll keep you updated on that. And you can join live Thursdays if you want to join the comment section. Okay. Thank you, everyone. We'll see you next time.